What's good, YouTube? It's your boy Cookie FX here, and today I'm bringing you guys a I don't want to call it like a strategy video. It's more of like a informational video on something you can add into your strategy. So yeah, we're gonna be talking about divergence. So first things first, this entire image, you want to write it down. You want to keep it on your computer. The point is you want to have this in your mind, because there's regular divergence for bullish and bearish, and then there's hidden divergence for bullish and bearish. Okay, so basically in this video I'm going to basically teach you guys how you can use divergences to trade fake outs. So like I said, you want to definitely write this down, pause the video, write this down, and yeah, let's get into it. So first things first, I'm on Euro USD on the 15-minute. So before I even get to the strategy, to add the indicator, you want to go here, and then it's RSI Divergences by this person. I can't see the entire name, but once you guys see this, this is the divergence indicator that I use. Me personally, right now, as I said in my trading plan video, I'm currently in the process of compounding my account. So I definitely use divergence as a way to, I use it for when I trade fibs. This is why purposely I'm on Euro USD, because like pairs that throw a lot of fibs are like GJ, Euro USD, sometimes gold, and lastly GBP USD. So I noticed that those pairs throw the most fibs. So with that being said, I'm going to naturally show it with fibs, because I also use divergence as a way to I use it as a way to kind of let my fibs play out. Okay, like I use it as an extra confluence. So first things first, here, after you put on the indicator, the reason why I like this one a lot is because it tells you R, which I guess that stands for reversal. So let me make one thing clear first. Okay, when price and the RSI are disagreeing on the top, it's indicating that it wants to reverse for a sell. How it is here, that red R right there, it's indicating that it wants to break out for a sell. When it's on the bottom, when price and the RSI is on the bottom and it's disagreeing, that means it wants to go for a buy. Now let me make one thing clear again. When you experience divergence, there's never gonna be like a major drop. So what I mean by that is, like, for example, this is the 15-minute chart, as you guys can see, but here, this entire move, this entire like sell, when you go to like the 1 hour, like let's go to the 1 hour and the 4 hour, so that you guys can see what I'm talking about. Okay, when you go to the higher time frame, you can see that these are just like straight bearish candles. Okay, RSI will never, I'm sorry, divergence, it will never have like a big drop like that. It'll have kind of like a small drop. So here, right, so say if you were in this position off the 15-minute, right, you would have held this trade for like 2 hours, and then you would have gotten out because there's liquidity sitting down there. Okay, so that's something that I wanted to point out about divergence. But anyways, with that being said, let's get into it. Like I said, write that down. The top of price and RSI, it's indicating that it wants to drop for sells. The bottom of price and the RSI is for a buy. Okay, so let's look at this one. By the way, I have 7 examples on this video. So this one, okay, there's, as you can see, that there's double divergences, that's what I like to call it. So there's divergence leading for the bottom, and then there's divergence leading for the top. As you guys can see, whenever it's for the bottom, it's indicating that it wants to go down for a sell. Now let's be honest here. Okay, where's my trend line? Here, that entire double, also I actually forgot to say this at the beginning of the video too, our people who trade M's and W's, it's a great divergence is a great way to trade divergent. I'm sorry, let me say it again. People who trade M's and W's can use RSI divergence to enhance their trading strategy. So like I said, people who are taking Fibonacci plays, like I said, I want to I want to make a like a series about like how I trade Fibonacci, so you guys can understand how I use divergence to build my I use divergence as a confluence to be able to build my fibs, my Fibonacci's. Okay, so where's the structure? Where's structure? These lows. Okay, so people who are taking the fib from this high to that low, from right there, it's a good fib play. Let me actually extend it. It's a very good fib play. Okay, you have a box right here on your golden zones, which it actually gives you 2 entries. Okay, so you have, actually, also let me say this about fibs and divergence. The market moves in Elliott waves. So what do I mean by this? Let me take this off as well before I go to Fibonacci. As you guys can see right here, it broke structure to the downside. It have to pull back up. Okay, it has to pull back up. This is why I say it's Elliott waves, because the first impulse, so you have 0, not the first impulse, the first wave. You have 0, you have 1, it retraces back to 2, then you have 3. In this case, it's a W. It's like a messed up W. So you have 3, then there's a double top, which is 4, and then 5 is, well, I'm sorry, it's an M. So 0.2 and 4 are a 0.2 and 4 are a double top. Okay, so you have 0 for the extension going to from 0 to 0.1. You have the retracement from 0.1 to 0.2. From 0.2 to 3, you have an extension. From 0.3 to 4, there's a double top. So what happens? What does that tell you? That means people are like their Fibonacci, they're starting their fibs from 0 to 1, and then the pullback happens from 1 to 2, and then their TPs are from 2 to 3, and then in this case it was an M. Like I said, people who trade M's and W's, it makes perfect sense. So then from 0.4 to 5 is where TP gets smashed. So let's take off these Elliott waves and let's start our fibs. So you go here, from that low to this low, and look, it hits your golden zone for 50%. It pushes down from 0 to 1, 1 to 2, because the thing is, you guys also have to remember, it was also indicating that it wants to go for a sell. Not to mention this next divergence example, there's liquidity sitting there because people are buying. So what did the market do? It indicated that it was going to reverse, which it did. It reversed, pushed down for a sell, and then they pushed price back up. Now this little fake out, it was a fake out. I say that not for the people who took the sell. It was a fake out for people who took this buy off this divergence, because retail traders are going for the buy after this sell off. They're going for the buy, which is why the market pushed back up. But then it came back down. They tried to push it back up again, but then it just completely destroyed them. That's why this low with this blue candle is lower than this low, because there's liquidity sitting down there from people who are taking the buy position, not the sell. The real move was the sell, not the buy. I say that because there's RSI on the top, which is indicating for a sell. The RSI on the bottom doesn't happen till the next couple candlesticks. Now the reason why I say that the people who took the buy got stopped out is because, say you run your fib from this point to say you run your fib from that point to that point, if you don't take your position, if you don't take your profit off of your positions at a fast pace, you're gonna get stopped out clearly. So price indicated. So you could let me rephrase that. You could have taken the buy or the sell. The thing is that the sell was the real move, not the buy, because people who took the buy ended up eventually getting stopped out if they didn't take majority off and put their stop loss at break even. So what happened was, from this low, it came back up. They pushed price down to the golden zone. This is why I like trading Euro USD, because it throws fibs on top of fibs. But like I said, look at what happens after your TPs get hit. It melts completely down because there's liquidity here, and price already indicated that it wants to go for a sell. Not only to mention, but this has nothing to do with this video, but I'm just simply saying the 200 EMA is on a downtrend, so you should naturally be looking for sells, not buys. So that's why people who try to counter trend this move, they ended up getting stopped out if they didn't take their majority of TP off. So with that being said, that's why when you take when there's a trade that it has divergence on both sides, I'm not saying it's a gamble to trade it, but you are better off either taking the trade or with a lower lot size, and having just basically a lower lot size and maybe like a tighter stop loss, or you're better off just not taking the trade at all, because in a way it's kind of like a gamble trade in a way, but then again, like, not really. So let's look at the next example. Okay, we have RSI Divergence on the bottom. Price and the divergence down here, it's not agreeing. This is an oversold market right here. This is oversold, so the market has to push back price. The retail traders are going to try to push price back up, but like I told you guys at the beginning of the video, when divergence happens, it's not like a major move. Like all these wicks, that's weak buying power. There's no like, the banks are in play, but it's weak. There's no like major buying power there. Yes, you could take the buy because people right here are selling. So people right here are selling. Okay, they're selling, so their stop losses are sitting up there. So there's liquidity, and off the higher time frame, that's an area to fill. Now for those who have my course, know what I mean by areas to fill. So let's go to the replay mode. Also, there's another thing too about backtesting. You want to have the replay mode, because if not, you're not going to be able to see certain things properly. So say right here, okay, what's price indicating? It's indicating that it wants to shoot up for a reversal. Now again, nothing is guaranteed. Okay, there's liquidity sitting up there. As a matter of fact, there's liquidity on both sides. So take this and this. Now people started buying. People were taking their buys. So you know that people's stop loss was sitting right underneath there, and you know they were going for long targets. Eventually the market came back up and TP was smashed. But what ends up happening is that with divergence, again, there's not, like, you don't have, the move is not as, it's not a big like impulse kind of move where like, okay, it's changing the direction of where the market is going. This market is still bearish, clearly. So you can easily see that this market is still bearish. So with that being said, yes, you could take this buy, but you want to be in and out real fast. So let's go to the next setup. Same thing here. Now let me say this real quick. This divergence, I'm not taking it. Why? Because this is just purely consolidation. Now it's indicating that it's going for a buy, but this is more of like a ranging kind of buy where you really want to go for just a one-to-one. That's it, because there's no clear direction for where the market really wants to go. And then as you could tell, if you didn't get like a regular one-to-one, you would have gotten stopped out by this by these come on, trading view, you would have gotten stopped out by these traders right here, these sellers, because sellers are starting to place their orders right there. Also, another thing about divergence is that it also depends during the time of the day on when you're trading. So I mean, really anything does, to be honest. But as you can see here, is this an RSI trade that you would be taking? Not at all, because it's a range. There's no clear direction where the market wants to go. Not to mention, you end up getting stopped out, say if you try to hold the buy. Because again, look at the 200 EMA. If you want to go back to my 200 EMA video, look at the 200 EMA. It's showing that it's still on a downtrend. It's still on a major downtrend. So yeah, let's go. After that, let's go to the next example. Now look at this example. So remember how earlier I said, actually let's go to this one first, because this one makes more sense. Okay, so this move, there's divergence. Look at the indicator. Price isn't agreeing with the indicator. Okay, so it's indicating that it's going to go for a small reversal. Well, in this case, it wasn't small if you held it, because clearly price just melted. But at the same time, what it's also doing is it's mirroring this this side of the market. It's blasting up, consolidating, to then push back down and stop out those traders. That's why on my trading plan video, that's why I specifically stated that I'm not a swing trader, because the market always mirrors itself and it has to come back to destroy swing traders. That's why I like to be in and out of the market whenever I'm trading. So that was, price wasn't agreeing with the RSI indicator. So what happened was it broke out down here, kind of started consolidating to then push back down. But again, the move was only, like, RSI moves are only temporary, okay? Because as you can see, come on, trading view, as you can see, it's being overbought right there, clearly. Here, you just scroll down, this entire move is a move that is being overbought, because it's breaking out of the RSI. So for those who trade with Bollinger Bands and the RSI, like I know Mamba FX, he does that, you can be taking this clear sell, because it's breaking out of the RSI. It's showing you that it's an overbought market. Then there's divergence on the top, like it's the, you know what I mean, like then once you mark up your zones, there's clear resistance and stuff. So you could have taken that sell and held it. So let's go to the next example. Again, there's RSI on the bottom. This is an overbought market. It's indicating that right here, these candlesticks are probably news. But as you can see right here, it's indicating that this is an oversold market. It's breaking out of the RSI underneath. So what does the market have to do? It's going to push up, and then on top of that, that is just news where it has to fill it. So it has to fill in those orders. Like I said, if you go back to my course and look at the areas to fill, or what's seen as the gaps in the market, you can see that candlesticks like this, like major drops because of news, they have to get filled. So yeah, like I said, that's pretty much divergence. It's basically where the market, it's overbought or oversold, and it's indicating on price and the divergence indicator that it wants to indicate that it has to start pulling back now. It has to start selling. So that's pretty much what it is, especially off this one. Like this was a major this move was major for, as far as like people who took this buy, they ate off of this buy. It shows that it's an oversold market. There's clear areas that have to get filled. They're gonna shoot it back up there. And when I mean I mean the banks, the pensions, the hedge funds. So I think this was my last example, because I haven't marked off any of these. But yeah, this is my last example. So let's go into it. Now, like I said, you want to properly backtest this. You're not gonna get this stuff overnight. That's why I feel like backtesting, I feel like it's super important, because you start to train your mind to really see certain setups. Like eventually you wouldn't need the indicator, but for those who like to trade off indicators, you can strictly trade off indicators. You know what I mean? So let's look at the last example. Price on the bottom is going a different direction than the RSI, so it's indicating that it wants to drop. That's what the indicator does for you. That's why I feel like this indicator is so effective for people who like to trade fake outs. It's super effective because, as you can see here, this swing low, that's liquidity sitting down there. Eventually, people who are selling, you know, their stop loss is right above that that divergence. Where do you think the market's gonna go? Right towards that liquidity. Right towards that liquidity. So that's why people who trade fake outs, it's like RSI, like divergence, it's a perfect strategy to include. And this is what I'm also trying to get at, that the buying power or the selling power as far as divergence reversals, it's not that strong. Look at these wicks. The selling power, yeah, it hits your TP and you got a good risk to reward, but the selling power is not that strong as, let's say, these candles where there's no pullback. Like you could tell that the sharks are in there. But this is all retail trading right here. This is just us trying to, sell because it's indicating that it wants to go for a sell. So that's pretty much divergence. I hope you guys gain some knowledge out of this. Like I said, if you still need some advice, some more like knowledge, definitely either go back to watch my course, go back and continue replaying this video, continue backtesting, and if you still feel like you need some help, you need to book a one-on-one Zoom session with me, just because, like I said, that's where I'll be able to help you like one-on-one personally, where you get that like one-on-one type of attention. But with that being said, I hope you guys enjoyed this video. Peace and love. I hope you guys were able to gain some knowledge out of this. But with that being said, on to the next video. Peace and love.